Mortgage rates are up. What are your options if you can't pay your mortgage? Ted's here to discuss it starting right now.
This is Debt Free in 30. Here's your host, Doug Hoyes.
Okay, I did some research. Between March 26, 2020, which is just after the whole lockdown thing started, and March 1st, 2022, the Bank of Canada target overnight rate was 0.25%. Okay, so that's
right.
Almost 2 years, basically free. But then, March 2nd, 2022, last year, the Bank of Canada raised interest rates 25 basis points, and they kept raising rates another nine times.
In total.
So that by June 7th, 2023, the Bank of Canada overnight rate, another 25 basis points. So now, as we record this, it is at 4.75%. The next rate decision happens on July 12th. Will they get it up to 5%? I have no idea. We're not making predictions about that.
We have our suspicions.
But what do we know, right? What I do know is that this is the largest cumulative interest rate hiking cycle since the 1980s. Okay, you and I weren't even alive in the 1980s.
No, you won't remember this. My first car loan was at 19.9%.
I don't remember your
back
first
in
car
1981.
loan. That is correct. When I bought my first house, which was, I believe, around 1989. It's in the book. I tell the story. Straight Talk on Your Money, still available on Kindle. I believe my interest rate was 13.25%, and that was not at the peak of everything.
Certainly wasn't.
So we've certainly had higher interest rates.
That's not the point.
That's not the point.
It's how quickly they went up.
Right. Very fast and obviously very low. And now mortgage rates are up into the 5 or 6% range or higher.
Higher than that.
Depending on what, you're getting a variable rate, 3 months, 6 months, 5 years. What are you doing? Now, more research, and I'll put links to this in the show notes. According to the Bank of Canada, 1/3 of mortgages have seen an increase in payments compared with February of last year, which is, like I said, just before the Bank of Canada started rate hikes. Okay, well, that kind of makes sense because
that seems like an understatement to me. I thought it was about 1/3 of every mortgage is renew every 6-month block of time.
Well, it depends, obviously, on where your starting point was, right?
Right.
So for fixed-rate mortgages, the average increase in payments at renewal will be the biggest in 2025, 2026.
Right.
Okay, well, that kind of makes sense because if you in 2020 got a 5-year mortgage,
if you were smart enough to lock it in,
then I guess 2025 is when it's going to hit.
Right.
For variable rate mortgages, the average increase depends on whether the payments are variable or fixed.
Right.
And this is something a bunch of people don't seem to grasp. So variable payments means your payment changes every single month.
It fluctuates.
Well, obviously, those borrowers have already experienced an increase in payments of close to 50%.
Right.
With the bulk of the increase obviously taking place over the last year. Fixed payments, these borrowers will need to increase their payments by approximately 40% to maintain their original amortization schedule, assuming a renewal in 2025 or 2026. Now, again, it all depends when you started, where you're at. These are all...
Yep. Well, and the impact on the fixed payments is more and more of your payments been going towards the interest. Mm-hmm. In fact, some of them are probably underwater on the interest, right?
And amortizations have had to be rolled out. Now, the point is that virtually every mortgage that's coming up for renewal is going to be at a higher rate. Because if you've had your mortgage for more than a year, the rates were lower. Right. Well, in fact, I guess if it's for more than 6 months, the rates were lower. Significantly lower. So, and again, we'll put some charts up that show all this.
Right.
Our homeowners bankruptcy index,
the thing that was at 0 for the longest time?
The thing that was at 0, the Hoyes and Michalos homeowners bankruptcy index, which shows the percentage of our clients who owned a home at the time they filed their insolvency.
Right.
And as you'll recall, back in 2011, it was about 1/3 of our clients. Yep. And then it got down to pretty close to 0. Now we're sort of, in the last year or so, we've been in the kind of, 0 to 5% range, still pretty low.
It's going to go up.
It's going to go up. Yeah. So we are still early in this whole process. So question number 1 with that preamble, and everyone loves the preamble. A lot of people are now paying more for their mortgage. Obviously, we just talked about that.
Right.
And in a lot of cases, their mortgage payments have gone up faster than their income. There's lots of people who are paying $1,000 more per month on their mortgage. Their pay after tax did not go up by $1,000 a month.
Right.
So We have not seen a collapse in the real estate market. Everybody is not selling their house. So how is it possible rates have gone up that much and the world hasn't ended? How are people coping?
So you got to find more money. So the first place you look for more money is, do you have any savings? Which makes sense. And so you tap out whatever savings you have access to. And if that's not sufficient, well, what is the next place you go for more money?
Debt.
Your debt. That's right.
I borrow.
You increase your credit card rates. And I believe we predicted all this over a year ago.
I believe that's correct. And so I'll put on the screen for those of you watching on YouTube, the savings rate.
Which has basically gone back to pre-COVID levels.
We're getting there.
Yep.
So in 2018, the savings rate was pretty much zero.
Right.
We didn't save any money. Why didn't we save any money? Well, why would we? I've got a line of credit. That's my emergency fund.
And I'm paying 0.25% interest on my mortgage.
And the bank is going to give me 0% in a savings account. So why would I save money?
Right.
So then the lockdowns hit. First quarter of 2020, the savings rate went up to 26.5%. And why was that? Why did it jack up so much?
Well, primarily because nobody had any way to spend their money. And so you accumulated it.
And I can't go on vacation. There's nothing to buy, supply chain issues, whatever. So if I'm not spending money, well, it accumulates in my bank account.
We were all hiding in the bunker.
And I was also able to pay down debt too.
Right.
Because, if I'm not spending, I might as well pay down my credit card or whatever. So savings rate went way up.
And credit card debt went way down.
So we'll put the chart. We'll go between these two charts. So the savings rate spiked up to 26% in the first quarter of 2020, and it has been falling ever since. The first quarter of 2023, which is the most recent data we have, it's now down below 3%.
Right.
So you're
heading
right.
quickly towards zero.
That's certainly seems to be the direction it's going.
Right.
We'll throw up another chart showing household credit card debt. And this is exactly what you predicted. So when you look at the chart, it goes back to 2013. And for those of you who are watching on YouTube, you can see it. For those of you listening on the audio podcast, pretty easy to understand. Right. The chart goes up until 2019. And then boom, we hit the pandemic and the credit card balances crashed because, again, can't spend any money. Right. Whatever money I've got coming in, well, why don't I pay down my credit? Why would I put it in a savings account earning 0% if I can throw it on my credit card, which is a 20% interest rate? Right. Well, obviously, we sort of bottomed out at the end of 2020, and since then, up. And so the most recent data we have, the Canadian household credit card debt is once again higher than it was prior to the pandemic.
Yeah, I mean, it was roughly last Labor Day when it equaled what it was pre-pandemic, and it's going to continue to climb.
And so that's what we think is going to happen. Okay, so the question I asked you was, how are people able to continue making their mortgage payments while they still had some savings?
Some people did.
Some people, not everybody, but some people did. So they've been drawing that down. And well, if I had paid down my debt during the pandemic, I've got perhaps access to a line of credit, a HELOC,
right? Or
I make my mortgage payments. I can't make my other payments. I put them on my credit card. And that's where we are today.
Correct.
Okay. Now, here's the point of the show. Took us not 8 minutes to get there, but here's the point of the show. So what if you start struggling with your mortgage? What do you do if you can't afford the increase? So when someone comes in to see you and they say, hey, Ted, I got all this debt, but I'm also starting to get behind on my mortgage. What's the thought process? Where do you start? What's the advice you give someone in that situation?
So we're predicating all of this on the assumption that you have to have some place to live. So you can't just decide you're going to sell the house tomorrow and move out and everything's going to be hunky-dory. It just can't happen. So you've got to continue to find ways to make those mortgage payments. And so if you're struggling with the payments, the first place to do is talk to the bank. Just about every contract that you have with a bank for some kind of long-term loan has provisions that allows you to skip payments, might help you with deferring interest. There are things the bank may be willing to do. There were lots of programs during COVID. Now the question is, are they still willing to extend those same kind of benefits to you now? If you don't ask, you won't know.
So you're talking about your mortgage lender, which may be a bank, maybe whatever.
Right.
So you could go to the lender and say, hey, look, I need to skip next month's payment.
Right.
And they may say no, or they may say, fine, we'll tack it on to the end.
Right.
If they do allow me to defer a payment or two, that helps me today because I don't have to make the payment.
Yeah, it's not a long-term solution because what it does is it frees up cash for a month or two, but you're now actually going to end up paying more for those payments because there'll be interest on the interest.
And that's really a Band-Aid, right?
It is. That's all that is. All that does is buy you an immediate inflection, a reduction in your outflow for 1 month, maybe 2. So it doesn't solve the problem. It just gives you time to think.
And I guess that would make sense if my issue is I broke my foot. I'm going to be off work for a month, but then I'm going to be able to go back to work. I don't know how long it takes to recover from a broken foot, but let's assume it's 1 month. It's probably longer than that. So that's really all I need. I need that 1 month break. If the bank will give me that, I'm good. But if my problem is my mortgage payment has gone up by $1,500 a month and my paycheck has gone up by $500 a month, I'm $1,000 short every month. Getting a 1 month deferral isn't going to help me at all.
That's right. So the money's got to come from someplace. So you talk to the bank. The next thing you got to do is look at your expenses. And so you got to go through everything you're paying for every month on a regular basis and say, how much can this be reduced? Now, the complicating factor here is, of course, that inflation's been through the roof for the last year. Your groceries are probably costing you 25% more than they used to. Gas for the car, it's still up from what it was, even though it's come down from the peak. Everything is costing you more. So looking at your expenses is a practical thing to do, but it may not be realistic. Like there may not be enough ways to find that $1,000.
Well, and for a lot of people, their biggest expense is their mortgage payment.
Right.
So if my biggest expense has gone way up, I can't cut that. So I'm kind of pooched on that. Now, is it possible? You mentioned talking to your lender about a deferral. Okay, can I skip a payment? Can you talk to your lender about stretching out the amortization?
You can. Certainly that would be part of the conversation. Or you can look at refinancing as an option as well. I mean, if you have equity in your house, there are options that are available that aren't available to everybody.
And I guess it depends on what your amortization period is now.
Yep.
And again, I think everyone understands what we're talking about, but amortization means...
What's the period of time that you're going to repay the mortgage, the debt on the house?
So if when I got the mortgage, it was 25 years.
And you've been paying for 10 years.
It's now 15.
Right.
I did that math in my head.
And so it's not difficult to go back to 25.
Yes.
Just acknowledge that you're going to be paying interest again on those extra 10 years, but cash is king. If you haven't got the money, that may be what you got to do.
And I would encourage everyone to go onto the interweb. There's tons of mortgage calculators. Every lender has them.
Right.
And punch it in. Say, okay, if I change the amortization from 25 to 20, from 15 to 25, whatever, what difference does it make? And on a monthly payment basis, going from 20 years to 25 years does not make a massive difference. Like it's not going to cut your payment in half.
Nope.
But what it will do is add 5 more years to the payments.
Right. So you'll end up paying more interest, but it will free up something. And the longer you've been paying your mortgage, obviously, the more room you're going to have for a difference. So you're right. The 5 years from 20 back to 25 is not a big deal. 15 back to 25 is a big deal. 10 back to 25 is a huge deal. But, you know.
Yeah. So I would crunch the numbers to see what would actually work. And then you've got to talk to your lender to see if they're willing to do it. And the lender might say, look, you're locked in for the next 3 years. Why would we make a change? Well, the answer is because I'm at a lower interest rate.
Right.
They'd be happy to unlock your mortgage, jack up your interest rate, and increase the amortization. And
so the the payments may not change.
That's right.
As we're thinking,
because now your interest rate goes up. So now you talked about refinancing. Well, is it possible to get a second mortgage or a home equity line of credit or something for $50,000, and then I use that $50,000 to be making my mortgage payments for the next 2 or 3 years,
which makes you scratch your head.
You're putting debt on top of debt,
right?
So that does not seem like a fantastic solution. But a lot of this depends on what your crystal ball says,
right? So,
do you believe? And I'm not asking you,
right?
Because we don't.
He's going to in a minute, though.
Yeah. You, the listener, do you believe that interest rates will be lower a year or two from now than they are today?
Right.
Do you believe the economy will be better? Do you believe you'll have a better job? Is your situation going to improve? If it is, then hanging in there for a year kind of makes sense. So I take on some extra debt for a year, but a year from now, interest rates are lower. I refinance. I live to fight another day. If you think interest rates are going to keep going up, do you want to be kicking the can down the road?
Right.
Probably not. Now, I believe in our year-end podcast, I predicted that interest rates would be back down to 3% by the end of the year, I think was what I predicted.
Could be. I don't believe I agreed with that.
I don't believe you did. Or maybe it was the inflation rate. I think
Right.
I predicted the inflation rate would be back down to 3% by December. I guess it's going to have to really start falling pretty quickly to get to my prediction, but I still stand by my prediction.
Right.
If inflation goes down, well, then I assume eventually interest rates and everything follows.
Well, and one of the difficulties now with inflation, though, is now we're getting the whole wage half of the cycle, right? Everybody wants a bigger increase. So
It's kind of hard for inflation to go down if
we
wages
have to pay
are
more
going
for
up.
everything else. That's right.
Now, you glossed over the obvious solution here because you said, well, everybody needs a place to live. You can't just sell your house.
Right.
Well, sure you can.
Yep. Or at least you can try.
So what's wrong with that option?
Well, it's not necessarily a bad option. It depends on the priority you place on owning your own home. But before you put your house up for sale, look to where you want to live or where you are living to figure out what's available for rent and how much it's going to cost you. I mean, rents have increased faster than interest rates. And so it's difficult to find some place to live at an affordable rate.
Yeah, obviously we've had massive immigration into Canada, and so that puts pressure on rental supply. And if house prices are out of control, I can't buy a house. So what do I do as I rent?
Right.
So that puts pressure on the rental market. But in most cases, rental rate, well, no, this may be totally inaccurate what I'm about to say, but in general, rental rates are less than owning rates.
Yes,
because you got to pay the mortgage, the property taxes, maintenance.
I mean, the
all that
math
kind of
we
stuff.
used to use was it's about 25% less per month to rent versus owning.
So
Factoring in taxes, maintenance, all the things that you were just talking about.
So $1,000 mortgage payment would equate to maybe $750 in rent. And obviously there's no place to rent for $1,000 a month, but
right.
And landlords, people who own condos and rent them out, are, if they bought the condo 2 years ago, they're absolutely for sure negative on the cash flow if they didn't have a massive down payment on it.
Right.
So they're losing money, which kind of proves the point that it is cheaper to rent than to own in the short term. So your advice is, okay, where could I rent? And maybe I can't rent the house next door where I'm living now because it's not up for rent. Do I have to move to a different school district, whatever? But if I can do that and sell my house, I got to make sure I'm actually getting some money when I sell it, I guess, too.
Well,
right?
you got to be able to clear up whatever your obligations are that have been putting you underwater.
And you want to be into a cash flow position where you're better off each month. So when you have that discussion with people, which I'm sure you have all the time,
Every day now.
what's the response when you say, well, maybe you should think about selling your house?
Yeah, so the automatic response is, I can't do that. I can't. You know, kids are in school. I live here. The house is the most important thing. The only other thing that people react the same way as houses and mortgages, I got to keep my car. But we'll do that on another show.
Yeah, well, and those are the two big expenses for a lot of people,
Right.
a house and transportation. And those are the only two things I really own.
Right.
But I also have an emotional attachment to it.
Mm-hmm.
I'm not emotionally attached to my car, as you know, but I'm different.
The Queen song comes to mind.
That's right. Yes. Whereas your car, or sorry, your house. Well, I live there. I mean,
Yep.
and
you got to live someplace.
Yep. So it's a very difficult decision. I know when I have that discussion with someone, you don't just come out and say it. Well, why don't you sell your house?
Right.
It's, well, let's look at all the different options.
Yeah, and I always predicate it with, well, you know, one of the things we have to look at, even though if you're not seriously interested, is what happens if you were to sell the house. Mm-hmm. And then you walk them into that whole nature of the conversation. But it's a difficult conversation to have.
And I always make sure that I get them to do the math for me.
Right.
So how much is your mortgage payment? How much is property taxes, condo fees, whatever? How old is the furnace? Have you ever had to fix the roof? All that kind of stuff. And let them come up with the numbers.
Right.
A bit of a sidetrack here. We've had this question come in on our website a few times. So I'm going to ask you the question. Can you pay your mortgage with a credit card, your monthly payment on your mortgage?
Well, you could certainly arrange to take a cash advance on your credit card to make the mortgage payment. And I believe you could probably set up the automatic payment to come out of a credit card.
Yeah, we don't recommend it, though.
No. Can I is not the same as should I.
Yeah, right. You're really racking it up. What about is my mortgage payment higher or lower, all else being equal, if I'm paying weekly, bi-weekly, monthly? How does that work?
Well, so the more frequently you're making the payment, the lower your interest costs overall are going to be because you're paying down the principal on an accelerated rate. The total payment you're making in a month, though, might actually be higher. So let's say you're paying $1,000 a month and you switch to $250 weekly. Well, in fact, you're going to be paying on average, what is that? About $1,100.
Yeah,
because every 6th month you get that third payment.
Well, yeah, if you're paying weekly 4 times a year, you get 5 payments.
Yeah, 4.3 per month anyway.
Right, and if you're paying biweekly, then it happens twice a year that you get 3 times where you're making the payment.
Right.
So if you are currently paying weekly $250,
right, and
you switch to monthly $1,000, well, I guess you're saving yourself $250 4 times a year.
Yep. And the trade-off is so you're saving that in your immediate cash flow, but you're increasing your interest costs correspondingly over the long term.
Yeah, and we're big believers in setting up your, well, at least I am. Maybe you're not. I'm a big believer.
Set everything up on your paydays.
Yep. And so
because if the money's out of your account, you can't spend
gone.
it.
Well, plus I don't have to budget.
Right.
So if I get paid weekly, I want my mortgage payment to be weekly on payday. And obviously that's the way we set up all our consumer proposals here as well.
Right.
And so from a cash flow budgeting point of view, you are better off matching your payments with your income.
Correct.
But if you're really trying to squeeze every last dollar out, I can see that maybe I want to switch to monthly so I've got less payments.
Yep.
I don't recommend it, but it's something to consider. Now, what happens if you've thought about everything and you've talked to your lender and you've tried to cut your expenses and it's just not working out? Can you just say, you know what? I'm walking away from my house. Here you go, lender. Here's my keys. See you later. I'm out of there. What happens?
Well, you certainly can. At any point, you've got the right to surrender your security, and you're saying to the lender, okay, realize on my security, then come after me for whatever's left. And so if you think the house is underwater, you got to understand that once they do sell it, they're going to come looking to you for the rest of the money.
So underwater means when they sell it and pay all the legal fees and penalties to break the mortgage and everything else, if they end up with less than what's needed to pay off the mortgage, that's underwater. There's a shortfall. They're coming after you for it.
Correct.
Now, what if I do the math and I go, well, I think there's still $50,000 of equity in my house.
Right.
I don't want to be handing the keys back to the mortgage holder then.
Well, we certainly wouldn't recommend it unless there's some reason that you can't do it yourself. You put the property up for sale. Even if you have to lower the price from what you really optimally want for a quicker sale, it's going to be cheaper than letting the bank or the finance company sell it for you.
Because they've got lawyers involved and everything else.
They're going to add 25 or 30 grand just in fees.
Yeah, right off the bat. So now, again, you got to do the math because when you pay off a mortgage early,
there's going to be penalties.
And you want to factor all that into it. So selling the house may be a good idea, again, based on the math. So,
but like all of this stuff, I mean, these things are so confusing, and you're talking about something that's so important to a family. Find someone that you can trust that you can talk to. I mean, we'll run all these numbers for you, and we'll help you do them yourself. Talk to somebody at the bank. Talk to whomever your financial advisor. Talk to your parents or family members. Somebody probably has got more knowledge than you, but you need to get an objective person to look at this for you, not just yourself.
Yeah, and I think the starting point is what I said earlier, crunch the numbers so that you can actually see what the impact of it is. So, okay, someone comes in to see you and they're saying, hey, Ted, I'm having trouble keeping up with my mortgage payment. And you dig deeper and you go, oh, I see that you also have a bunch of other debts.
Right.
You got credit cards, you haven't paid your taxes in full, you got other things. So then what's your advice? What's your advice for someone who has a mortgage but also has other unsecured debts?
So let's fall back on the famous saying that cash is king. So if the reason you're having problems making all of your payments is because you've just got too many payments, maybe we can do something about those lines of credit cards, personal loans. I noticed you didn't mention payday loans. You're just not trying to push my buttons today.
I didn't want to say the P word.
It may very well be that if we do something to deal with all of your other debts, maybe the mortgage can become manageable. And so what we're talking about is a consumer proposal.
So someone comes into you and they've got $50,000 worth of unsecured debt. So again, credit cards, payday loans, income taxes, bank loans, whatever.
Yep.
And they own a house. If the house explain to me how equity is going to factor into that then.
Well, so whenever you're offering your creditors some sort of deal through a proposal where you're saying, look, I can't pay my original contracts, I'm going to pay back part of my debt, we have to look to see, well, what would they be entitled to if you liquidated your assets? So if you sold your house and there's money left over, that's effectively equity. And so if you want to be able to keep your house, well, let's go in the example. So the person came in and they've got that $50,000 you were talking about. If we do the math and figure out there's $25,000 worth of equity if the house is sold, then the creditors, the people you owe, are not going to agree to anything less than what they'd get if the house was sold. So they're going to want that $25,000. If it turns out there's no equity, well, then that $50,000 we could probably offer to repay as little as $15,000. It all depends on your circumstances.
And that's what the world looked like in 2011.
Right.
Because when people came in to see us, their house price wasn't worth a whole lot more than what was owing on the mortgage.
Yep.
So we were able to do a proposal. When they came in to see us, last year, and their house was worth $1 million and the mortgage was $300,000, well, there's no deal to be made. And how do you calculate equity?
Well, and so it's a kind of a two-tier number. So the quick blow is this is what's fair market value, and we pick the middle of the range or whatever price you'd get if you had to sell it in 60 days. And we subtract the mortgage. So that's the first level of equity. The next level is, well, there are all these closing costs that you got to kick into. So the realtors, the lawyers, the whatever property tax
penalty to break the mortgage,
all that stuff. That's right. And so your equity number is one of those two. That's the range. And depending on your other circumstances, so how stable is your employment, your income, we'll use one or the other when we're approaching the people that you owe to say, this is the deal we want to make.
Yeah. And so if we do the math and like you said, there's $25,000 worth of equity and you got $50,000 worth of debt, then the minimum proposal we can offer is $25,000.
Right.
We can't go to them and say, hey, how about 10? Because they're going to say, no, sell the house and give us the money.
Right.
And so the lender, the lenders, the people you owe money to, when we go to talk to them about this, they can say, well, where'd you get that number from? So we actually have to show them, here's the appraisal that we had done.
Yep.
Here's the copy of the mortgage document that shows how much is owing. We got to support these numbers. Here's the math.
Right.
And then they will, possibly consider accepting it. So a consumer proposal is a good way to deal with your other debts,
right, to
free up the cash so that you can keep the house.
And if you're looking at a second mortgage, a consumer proposal actually might make more sense as well. The math that I've done in the past is a consumer proposal, if you have to repay 100% of the debt plus the fees for the proposal, is the equivalent of getting a mortgage at about 13%. Well, so if it's going to cost you more than 13% to get that second mortgage, or you can't get approved for the second mortgage, a proposal might make sense, even if you got to repay all the money. There are times that the math just makes sense.
And which was your point. Come in and talk to someone such as ourselves, because our initial consultations are no charge.
Right.
The law says we can't charge you.
Right.
I don't know if that's a good law or not.
Well, but another point is, of course, if you talk to somebody that wants a fee, get the hell out of there.
Yeah, right. Yeah. And hopefully in the fall, we'll be doing a show about how the government has cracked down on these people. I've been waiting for 6 years to do that show about how the government is cracking down on all these scam artists who charge these huge fees to refer you to a trustee. But
anyway,
we're not doing that show today.
Not today.
Because it has not yet happened. But yeah, and when you come in to see us, that's what we're going to do. We're going to say, okay, talk to a real estate person. Let's find out what your house would sell for. Let's get the printout from the bank, find out what it's called a buyout statement. How much would it cost? What are the other fees and everything? Let's figure out what that number is. And then let's figure out, what are you paying now on all these debts? What kind of deal do we think we can do? And the answer might be, you know what, just go get a second mortgage.
Right.
That's cheaper. You got lots of equity. You can afford it. Or maybe you refinance the existing mortgage, because when you refinance, well, if you're going to stretch it out over 20 years, then the monthly payment perhaps is a lot lower than what you're going to pay under any other circumstance. Right. However, if the answer is, well, I talked to my bank, they said, I don't qualify.
Right.
My income is not sufficient, whatever.
Our commercials say we'll help you, but in reality, we can't.
Right. We can't do it because we only want to lend to people who don't need the money.
Right.
And once you get over 80% loan to value, okay, now costs go a lot higher, a lot more difficult to get it. So the answer may very well be, here's the proposal we need to offer.
Right.
Let's see if the creditors agree to it. So that is a conversation. We don't have a lot today because equity in houses is still high.
Right.
But
it's more common than it was 3 months ago.
And I suspect by the fall and by next year, it will be
more common
considerably more common. I mean, the Hoyes and Michalos Homeowners Bankruptcy Index, what do you think it's going to be next year if it's sort of
double?
So from the 5% range to the 10% range.
Yep. And it'll go higher than that.
And it eventually got to it was a third or something, I think, in
the peak
in 2011.
I'm still of the opinion that interest rates are not going to retreat this year. I mean, so you and I disagree on that. Inflation maybe they get it under control. I'm not here and there on that one, but
I don't know if we've ever been right in our predictions, and I don't know if anyone has ever been right.
Right. Well, if we were, we'd be gazillionaires.
We'd be rich, right?
Are you a gazillionaire?
I'm not a gazillionaire. So, like, show me the person who a year and a half ago said rates were going from 0 to 5%. Like, who is that guy?
Right.
And I don't know who that person was. So it's very difficult to project, which I guess is, and this will be my closing comment, we don't know what the future is.
Right. Nobody does.
But if you can get your debt under control now, you're a lot more insulated from whatever can happen.
There's no argument against getting your debt under control. Like, why? Why would you let the cancer continue to grow?
Right.
Solve the problem.
Exactly. And if there's the potential that interest rates are going to go higher, well, getting your debt under control now is certainly better. So, okay, summary then. Yeah, think about selling your house, because it does, perhaps release some cash, certainly releases some cash flow each month, but you got to crunch the numbers and see if it makes sense in your situation.
Correct.
And
talk to the bank. Maybe there's some sort of refinancing or restructuring you can do. People will then use up their savings. If you're already falling back on your credit, you need to talk to somebody. Things are already out of control.
And maybe it does mean, okay, I'm renting out the basement, I got to bring in a roommate, whatever it is. You look at all those options, and one of the options on the table is the consumer proposal. Can I make a deal with my unsecured debt, free up some cash, and therefore I can continue to make the payments on the house? That's really the cycle of events. Ted, thank you very much. Mortgages, this will be an issue we will be talking about again in the future. It's not a one and done thing. So that is our show for today. I will put full links to everything we talked about in the show notes, both on YouTube and whatever audio version you're listening to. I'll put the link to the interest rate so you can see how they've all changed. I'll put up the Bank of Canada as well so you can see what we're referring to. I'll put a link to Butler Mortgage if you want to crunch the numbers and see what mortgages cost, and all the details are there. So if you're watching on YouTube, click all the buttons. You guys know the routine, and subscribe on Spotify, Apple Podcasts, whatever audio platform you listen, so that you can get the podcast every Saturday morning. That's our show for today. Thanks for listening. Until next week, I'm Doug Hoyes. That was Debt Free in 30.